Hey, what's going on, guys? TG here, and today I'm going to be showing you guys my favorite option strategy called running the wheel. So, running the wheel kind of sounds a little complicated, but it's actually very simple. And this is what you do basically. So, I'm going to give you the example that I did. So, we look at Apple. You know, everyone knows what Apple is, it's the biggest company in the world. So, here's what I would do. I want to buy Apple, right? Apple's sitting at $110.33. So, I have a couple options. I can buy Apple right now for $110.33. I can B, wait to see if it goes lower and get a lower price. Or C, I can sell a put on Apple and get paid to buy it at a lower price. So here's what I would do. I would click Trade Apple Options if you're on Robinhood. You would go to Sell Put, and I would click 110 because this is the price I want to buy it at. Or you can do 108, 107, anything. But let's click 110. Why not? So I click 110 and I would get paid $323. Okay? I get that money straight up. No strings attached. Okay? Now, let's say Apple stays exactly where it is at 110.33. I keep that $323 and I don't have to buy it. Let's say Apple goes up to 113. I still keep that $323. I don't have to buy it. Let's say Apple drops to 109. Now this is where you get assigned. So it's Friday. Market hits 4 o'clock. Apple's at 109. Okay. You're going to get assigned 100 shares of Apple at 110. You have to buy it at 110. So it would cost you exactly $11,000 to buy it at that price. Okay? And you would immediately be down $100 because it's at 109. So every dollar, since you have 100 shares, would be $100. But you got paid $323. So realistically, you're buying the stock at 106.77. Okay? And so you're already up big. And so now you have 100 shares of Apple. Okay? You got paid to buy Apple at a lower price. So now you have a couple options. What you can do is you can hold the shares if you want. You can immediately sell the shares and lose a little bit of money on appreciation, but make money overall because you got paid $323. Or you can do what we call running the wheel, which means you'd sell a covered call on Apple for whatever price you want. So let's say Apple's sitting around 109, okay? And you bought it at 110. So you want to make money on that option. So you'd sell, let's say, a 111.25 strike price. So you would then click that and you would sell the covered call and you would get paid $300. Okay? Yet again, like I said, that money goes straight into your account, no strings attached. So, a couple scenarios now. Let's say Apple stays exactly where it is. Okay? End of the week, Apple's still around 109. Well, you got paid $300 no matter what. That money's in your account, but you didn't make anything from the appreciation. Okay? Because Apple stayed exactly where it is. So, now what you can do is, you can just hold it for another week and then write another covered call the next week. You could sell it if you want. You can do whatever you want. Let's go to another scenario. Apple shoots up. It goes to 112.50 or 113. Okay? You have to sell your shares of Apple, all 100 shares, at 111.25. Okay? So if it goes to 112.25, you have to give it to them at 111.25. So you technically lose $100 from that, but you got $300 for selling the covered call. So your break-even point would be 114.25. So as long as Apple stays under 114.25, then you broke even on the trade, or you did better than break even on the trade. Than if you would have just held the shares upright and then sold it at that 114. So the good thing about covered calls is there's no way to lose. The only negative is that you cap your profits, if that makes sense. So you sell the 111.25 and it goes to 115. Okay, well, your break-even point was 114.25. So technically you lost out on 75 cents of appreciation. So you lost out on 75 extra dollars that you could have made had you just held the shares. But the good thing about covered calls is you get guaranteed money every single week. So I like it for that reason, because I like getting guaranteed money every week. And if it does go up to 125 or 111.25, well, I made $125 because it went from where I bought it at 110 and it went up to 111.25. So I made $125 from that. Plus I made $300 from the covered call. So I made $425 in total from that. Plus I made $326 from selling that put. So in that entire exchange, in the 2-week span that it happened, or 1-week span that it happened, I made $626 from it. So it's a really good way to just make some consistent money and play it super safe. And I've actually been doing that on Apple. I got assigned 100 shares of Apple, or 200 shares of Apple actually, at 115, and I went ahead and sold some at 120, a covered call at 120. And then I bought it back and locked in like $190 profit. And then I went ahead and sold some for 117.5. And I've already made $210 on it, and I can get a maximum of $218. I would probably just let this expire worthless tomorrow. So that's another $218 I made from it. And then I went ahead and sold one more because I bought 100 shares today. And I sold it and I just got $20 for $113.75 expiring tomorrow. So, it's a great way to make money on a stock that you like. And it's a good way to consistently make money. So no matter what happens, you're always being able to make money no matter what. If it goes up, you can sell the covered call. If it goes down, you can sell the put. And you can kind of just, as we say, run the wheel. It's just, if you sell the put, if you get assigned shares, okay, then you sell the covered call. Or if you sell the put and you don't get assigned shares, then you just sell the put again next week. So it's a great way to just like consistently make some money every week. And, that's what I'm planning on doing with Citibank. Because I'm probably going to have to buy it at 45 or 46, because that's where one of my puts is. But my breaking point is 45.33, and I got paid $267 to buy it at. So worst case scenario, I pick up Citigroup at 46, and then I go ahead and write some covered calls on it afterward and make some money. So I hope that made sense. I hope that wasn't too difficult to understand. If you guys have any questions, just let me know. But that is essentially what running the wheel is. It is selling a put and then waiting until you get assigned shares. And if you get assigned shares, then you sell a covered call. And you just keep selling the covered call until you lose the shares, until you have to exercise the shares to someone else, if that makes sense. Like I said, any questions, put it in the comments, send me a message. I'll answer it as best I can. But I hope you guys enjoyed this video. I hope this is going to help you guys sell some puts and, make some consistent money every week. I know it's really helped me. It's really helped turn my account around. And it's helped me make thousands and thousands of dollars from just doing this simple strategy every single week. So I hope you guys found it helpful. Hope you guys are going to use it in your own portfolios. And yeah, let me know what stocks you guys run the wheel on, or what stocks you think I should run the wheel on besides Apple and Citigroup. But yeah, guys, anyways, that's really about it. Hope you guys enjoyed. If you guys did, please remember to like and subscribe. We're almost at 250 subscribers. That's awesome. I can't wait. I'll definitely be doing a giveaway soon for all you subscribers. So, stay tuned, and thank you guys so much for the support. Anyways, have a wonderful day, and I'll talk to you next video. Bye.